If you've been in crypto for a while, you've probably seen this stat: trading volume. It shows up on CoinGecko, CoinMarketCap, exchanges, and Twitter charts. And for many people, it's used as a quick way to gauge whether a token is alive, active, or worth checking out. But here's the reality. Trading volume by itself does not tell you how healthy a market is. In fact, it can be one of the most misleading metrics in the entire crypto space. High volume doesn't mean deep liquidity. It doesn't mean stability. And it definitely doesn't mean that you'll be able to get in or out of your position without serious slippage. So today, we're going to break down the difference between volume and liquidity. I'll show you how to read market depth, understand slippage, and use real-world tools to assess the actual strength of a market, not just the numbers that look good on a website. What better place to start than with the basics? Volume refers to how much of a token is traded over a given time period. You might see that a coin has $50 million in 24-hour volume and think, wow, this project must really be active. But that number doesn't tell you who's trading, how many trades are real, or what price impact those trades have. In crypto, especially on centralized exchanges, much of that volume can be wash trading. That's bots or insiders trading back and forth to make it look like there's activity. It creates an illusion of demand, but the moment you try to make a real trade, you discover something else entirely. And that something else is liquidity. Liquidity is about how easily and efficiently you can enter or exit a position without causing a major price move. It's not just about the number of trades, it's about the depth of the market. It's about how many tokens are actually available at each price level on both the buy and the sell side. Let me give you an example. Let's say you're looking at a token with $50 million in daily volume. You decide to buy $10,000 worth. But when you place the trade, the price jumps 3%. That's slippage, and it means the market wasn't deep enough to absorb your order without moving the price. Now imagine trying to exit that same position later. If there's no real liquidity, your sell order could dump the price even harder. Suddenly you realize that this high volume market is actually very thin, and that's when traders get trapped. So how do you check liquidity? The first step is to look at the order book. On centralized exchanges like Binance or Kraken, you can click on the trading pair and view the depth chart. This will show you how many buy and sell orders are stacked at different prices. Pay attention to the bid-ask spread, the difference between the highest bid and the lowest ask. A tight spread usually indicates strong liquidity. A wide spread means fewer participants, more risk, and more volatility. You can also look at cumulative depth. Some platforms let you view how much dollar value is available within 2% of the current price on either side. That tells you how much the market can absorb before your trade starts to cause slippage. For decentralized exchanges, tools like Gecko Terminal or DEX tools are incredibly useful. They allow you to view the size of the liquidity pool, how much Ethereum or USDT is paired with the token, and how much volume is flowing through that pool. So here's the trick. You want to compare the size of the liquidity pool to the trading volume. If the volume is 5 or 10 times higher than the pool size, that can be a red flag. It suggests that the volume is artificial, or that trades are being routed through multiple swaps to inflate the numbers. On Uniswap, for example, you might see a token with a $200,000 liquidity pool and $2 million in volume. That means there's not enough real liquidity to support all of that trading without serious price swings. You can also check for token volatility using price impact stats. These show up right before you confirm a swap, so pay attention to that. Let's also talk about centralized exchange order books. You might see what looks like a deep market with lots of bids and asks, but if you watch closely, you'll notice something strange. Orders appear and disappear rapidly. This is called ghost liquidity. It's when market makers or bots use large orders to make the book look full. but they cancel them as soon as real volume comes in. This tactic creates a false sense of security. Retail traders see what looks like support or resistance and assume the price will hold. But in reality, there's nothing there, just flashing numbers and empty depth. So what should you look for? You want steady, consistent liquidity, markets where the bid-ask spread is tight, the depth is balanced, and the liquidity pool is large enough to support your trade without excessive slippage. You can also use tools like Trading Light or tensor charts for heat maps. These show you where large limit orders are sitting over time, giving you a sense of where real interest exists and where it might be fake. And don't forget to check the history. Has the token been through a major pump and dump? Did it suddenly appear with huge volume out of nowhere? Are there patterns of short-lived spikes in liquidity followed by long dry spells? That's usually a sign of manipulation. Ultimately, the lesson here is simple. Volume is noisy, liquidity is signal. Before you enter a trade, especially in a volatile or low cap project, ask yourself, can I get out of this position without getting wrecked? Who will buy from me later? Who's actually providing liquidity right now? If the answer is unclear or the depth looks fake, just walk away and thank yourself later. There are always better opportunities in crypto, but they're rarely the ones screaming the loudest. Let me know in the comments, have you ever been caught in a low liquidity trade that moved against you faster than you expected? How do you check liquidity before you enter a position? And if you want to learn more about the ins and outs of crypto and doing it the smart way, visit learningcrypto.com so you can avoid common traps and become a smarter, more confident investor. Thanks so much for watching. I'll see you in the next video.